Okay, let me ask you something, and I want you to actually think about this for a second before you just scroll past. You negotiated hard for that salary. Maybe you switched jobs to get it. Maybe you spent years grinding to finally crack that 70K, 80K, even 90K number. You remember the day you got the offer. You did the math in your head. This is it. This is the number that changes everything. You're going to pay off that debt. You're going to actually start saving, maybe even invest a little. Life is about to make sense.
Hi, I'm John, and I probably spend more time than I should analyzing money, how people think about it, and what really separates those who grow their wealth from those who stay financially stuck for years. I'm especially interested in the patterns, why some individuals seem to move forward with ease, while others keep repeating the same financial cycles without realizing it. If you're someone who wants to actually understand how wealth works beneath the surface, rather than just wishing for better results, then you're in the right place. Go ahead and subscribe, and if this video gives you a new perspective on money, don't forget to leave a like.
And then the first paycheck hits, and you just sit there staring at your bank account like something went horribly wrong. Where did it go? Like, where is the money? You're making $80,000 a year. That's $6,666 a month. But your deposit says, what, $4,200? Maybe less. And that's before rent, before groceries, before the car payment you had to take on just to get to the job that's paying you the money that somehow already isn't there. Here's the thing. You're not bad with money. You're not lazy. You're not doing something wrong that nobody told you about. The system was designed to take a massive chunk of your paycheck before you ever see it. And nobody, not your parents, not your school, not your employer, sat you down and explained exactly how bad it actually is. So, that's what we're doing today. We're going to tear open the paycheck, look at every single thing that eats it alive, and then, and this is the part most videos skip, I'm going to show you what you can actually do about it, because there is a way out of this, but you have to understand the problem first. Let's get into it. So, let's start with the number everyone throws around, $80,000 a year. That sounds like real money, right? And it is in a vacuum. But we don't live in a vacuum. We live in the real world, where that 80K gets attacked from every direction the second it leaves your employer's account. First hit, federal income tax. If you're single and making 80K in 2024, you're in the 22% marginal tax bracket. Now, a lot of people hear 22% tax bracket and think, okay, so I'm keeping 78 cents of every dollar. That is not how this works. And this misconception alone costs people thousands of dollars in mental accounting mistakes every year. Your taxes are structured in tiers, what they call progressive brackets. The first $11,600 or so of your income gets taxed at 10%. Then from there to about $47,000, it's 12%. And then from $47K up to your $80K, that chunk gets taxed at 22%. Your effective federal tax rate, the actual percentage of your whole paycheck that goes to federal taxes, is closer to 16 or 17%. That's roughly $13,000 to $14,000 gone before you even think about anything else. We're already down to about $66,000, and we've only talked about one tax. Next, and this is the one that really makes people's eyes water when they finally see it broken down, FICA taxes. This is Social Security and Medicare. Every working American pays 6.3% of their paycheck into Social Security, up to a wage cap of $168,600 in 2024, and then another 1.45% for Medicare on top of that. That's 7.65% of your paycheck automatically. On an 80K salary, that's about $6,120 a year gone, straight out. You never see it, you never had a say. And look, I'm not here to argue about whether Social Security is a good program or a bad program. That's a whole other video. What I'm telling you is that it eats roughly $510 of your paycheck every single month without asking you. So now we're at roughly $60,000, and we still haven't touched state taxes. This is where it gets really painful depending on where you live. If you're in California, one of the highest income tax states in the country, you're looking at another 6 to 9.3% on your income in that range. That's another $5,000 to $7,000 a year. In New York, similar story. Oregon, New Jersey, Minnesota. These states are quietly taking a huge portion of your check on top of everything the federal government already took. Now, if you're in Texas, Florida, Nevada, Washington, you get a bit of a break. No state income tax, which is genuinely one of the most underappreciated financial advantages of living in those states. People obsess over cost of housing. They don't run the math on what state income tax actually costs them over a career. We're talking hundreds of thousands of dollars over 30 years. Think about that. But let's use a middle ground. Let's say you're in a state that takes about 5%. That's another $4,000 a year off your check. Where are we now? We started at $80,000. We've lost $13,500 in federal income tax, $6,120 in FICA, $4,000 in state income tax. That's $23,620 gone. We're down to $56,380, and we haven't left the employer's payroll system yet. Not one bill has been paid, not one grocery run, nothing. Annualized, that $80,000 salary now looks like about $56,000 in take-home. Broken down monthly, you're looking at roughly $4,700 a month. And if you're in a high-tax state like California with no other deductions, it could be closer to $4,200 or even less. You signed up for $80K. You're living on $50K. That gap, that invisible, never-discussed gap, is what we're talking about today. But okay, let's say you've accepted the taxes. Let's say you've made peace with the government's cut, because here's where it really gets dark, because taxes are the only first layer. The second layer is the expenses that are basically mandatory if you want to participate in modern working life. Health insurance. If you're getting it through your employer, which most people are, you're probably contributing somewhere between $150 and $500 a month, depending on your plan and your employer's contribution. The Kaiser Family Foundation, this is a real research organization, not some random blog, found that in 2023, the average employee contribution for employer-sponsored family coverage was over $6,000 a year. Even for single coverage, it's around $1,400 a year on average. That comes out of your paycheck pre-tax, which is a silver lining, but it's still gone. Then you've got your 401k. And look, I'm not going to tell you to stop contributing to your retirement. That would be genuinely terrible advice. But I want you to understand that if you're doing the right thing, contributing 10–15% of your salary to your 401k, that's another $8,000 to $12,000 a year that doesn't land in your checking account. Again, it's going somewhere good, but it's gone from your monthly cash flow. So, strip out health insurance and retirement contributions, even conservative ones, and now your $56,000 in take-home is looking more like $44,000 to $48,000 a year before you spend a single dollar on anything. That's $3,700 to $4,000 a month to live your life in 2024, in a country where the median rent for a one-bedroom apartment is now over $1,500 nationally, where a used car payment averages $700 a month, where groceries for one person run $400 to $600 a month, depending on where you live. I'm going to run those numbers for you right now, and I want you to feel how fast this adds up. Rent, $1,500. Car payment, $500, we'll go conservative. Car insurance, $150. Groceries, $400. Utilities and internet, $150. Phone, $80. Gas, $120. Streaming and subscriptions you probably forgot you had, $50. And we haven't touched student loans, medical bills, clothing, eating out once in a while like a normal human being, or any kind of emergency fund. That's $2,950 in basics, leaving you with $750 to $1,000 for everything else. Savings, entertainment, travel, date nights, gifts, unexpected car repairs, a dental bill your insurance half covers. You are one blown tire away from a bad month on $80,000 a year. Let that sink in for a second. And this isn't a "you're bad with money" conversation. This is a math conversation. The math is brutal. The math was always going to be brutal. The question is what you do when you finally understand it. Here's where I want to introduce you to a concept that I think explains a huge part of this problem. It's called lifestyle inflation, and it is absolutely silent, absolutely deadly to your finances, and almost impossible to notice while it's happening to you. Lifestyle inflation is simple. Your income goes up, your spending goes up to match it. Not because you sat down and decided to spend more, but because having more money makes it psychologically easier to justify spending more. You got a raise. You deserve a nicer apartment. You're making more now. You can afford a newer car. You're doing well. Dinner out 3 times a week instead of 1 isn't a big deal anymore, right? Wrong. This is exactly how people who make $120,000 a year end up with less savings than people who make $65,000. I'm not making that up. Study after study on household savings rates shows that income above a certain threshold does not automatically produce more savings because spending inflates right alongside it. The technical term for this in behavioral economics is hedonic adaptation, the idea that humans adapt to new levels of comfort and then start treating them as the baseline. The apartment that felt luxurious when you moved in feels normal after 6 months. The car that felt amazing when you drove it off the lot feels ordinary by year 2. So you need something bigger, newer, better, just to feel the same level of satisfaction you felt before, and the spending never stops expanding. A 2022 study from Northwestern Mutual found that 36% of Americans, more than 1 in 3, say they spend more than they make, not occasionally, regularly. And the income brackets where this happens aren't just the low earners.
Because the spending grows with the income. Think about it this way. Imagine your paycheck is a bucket of water. Every month, you pour money into the bucket. The taxes are a hole at the bottom. Automatic, unavoidable, constant drainage. The fixed expenses are cracks in the side. Rent, car, insurance, phone. But lifestyle inflation is someone slowly making the bucket bigger. So no matter how much water you pour in, the bucket never seems full. You're always just getting by, always one step behind where you thought you'd be. And the most insidious part? The bigger the bucket gets, the more normal it feels. You don't even notice you've upgraded your lifestyle because it happened gradually. A slightly nicer apartment, a slightly newer phone, a slightly higher-end grocery store, slightly more nights out. Each decision felt small. Together, they ate your raise before you had a chance to save it.
So we've talked about what's taking your money. Now let's talk about what you can actually do. Because I didn't make this video to depress you. I made it because the only way to fight a system that's working against you is to understand it completely. Step 1. And this one is boring, but it is the foundation of everything. You have to build what I call a real number. Not your salary, not your gross pay. Your actual, after everything, in your bank account monthly number. Write it down. Add up every single deduction, taxes, insurance, retirement, all of it, and figure out exactly what you're working with. Most people never do this. They vaguely know their take-home, but they've never actually sat down and calculated the gap between what they earn and what they keep. That gap is the enemy. Name it. Know it. Step 2. Use your pre-tax benefits. This is the single most underutilized weapon that middle-income earners have. Your 401k contributions reduce your taxable income. Your HSA, health savings account. If your employer offers a high-deductible health plan, is triple tax-advantaged. You put money in pre-tax, it grows tax-free, and you take it out tax-free for medical expenses. It is the most tax-efficient account that exists in the American financial system, and the majority of people who qualify for it don't fully use it. In 2024, you can contribute up to $4,150 as an individual, $8,300 for a family. That's money the IRS never touches, at all. Step 3. This one requires some honesty. Go through your subscriptions, your recurring expenses, your automatic payments, not to slash everything and live like a monk, but to make sure every dollar leaving your account is a dollar you actually chose to spend. Most people find $100 to $300 a month in spending they genuinely forgot was happening. That's not cutting back. That's just cleaning up. Step 4. And I know people don't want to hear this one. Address the income side of the equation, because there's a limit to how much you can cut. You cannot shrink your way to wealth.
At some point, the math only works if the top number gets bigger. That might mean negotiating a raise. It might mean developing a skill set that's genuinely scarce and valuable. It might mean building a side income, something small at first. The point is to stop treating your current salary as a fixed ceiling and start treating it as a floor that you're actively working to raise. Step 5. And this is the mindset shift that ties everything together. Stop optimizing for how your lifestyle looks and start optimizing for how your financial life actually functions. Because here's the uncomfortable truth. The people who look the most financially successful are often the most financially fragile. The people who drive impressive cars and live in impressive apartments and wear impressive things are statistically more likely to have zero savings, high credit card debt, and no real financial cushion. Looking wealthy and being wealthy are completely different financial strategies. One costs you everything. The other builds you something real. Look, I'm not going to sit here and pretend this is easy. The taxes are real. The cost of living is real. The gap between what you earn and what you keep is a real, systemic problem that goes way beyond personal finance tips. And I'm not here to sell you some fantasy that a YouTube video is going to solve a structural economic problem. But here's what I do know. The people who figure this out, the ones who really understand where the money goes and build a plan around the reality of their situation, those people win. Slowly, quietly, methodically, they build something, while everyone around them is wondering why their paycheck never feels like enough. You already took the first step by watching this. You understand the problem now. You've seen the numbers. You know what you're working with. The next step is yours. Run your real number this week. Actually sit down, open a spreadsheet or a notes app, and figure out exactly what lands in your account every month after every deduction. Then look at your last 30 days of spending. Compare those two numbers. Whatever gap you find, that's what you're solving for. That's the number that changes your life. If this video helped you see your paycheck differently, share it with someone who's been staring at their bank account wondering where it all went. Because I promise you, they're asking the same question. They just haven't had anyone answer it honestly yet. I'll see you in the next one.